What's up you guys, I'm Dan, this is Frugal Not Cheap. Lately I've been hearing a lot more about dimensional funds. There's a financial advisor named Ben Felix who does a lot of great content on his website that has recently been talking them up quite a bit. And in my personal life, I found out not long ago that a friend of my wife's, she and her husband actually have their portfolio with dimensional funds as well. So what are these dimensional funds? How do they compare to Vanguard? And which suits my needs better? That's what we'll talk about in today's video. Hey guys, so Dimensional Fund Advisors. This was started in 1981 by David Booth and Rex Sinkfield, both of whom studied at the University of Chicago under Eugene Fama. Fama is famous for working with researcher Kenneth French on the Fama-French three-factor asset pricing model. This is something I studied myself during my coursework at economics. First, we look at the sort of classic or traditional capital asset pricing model, or CAPM, which basically says that returns over the risk-free return, so think of something like treasuries, any excess return, because you can actually diversify away, then the only thing that would be left is systematic risk. And this is kind of the reason why there's a sort of an equity risk premium over risk-free returns, is that there is risk that you cannot diversify away, that's systematic risk. Anyway, so Fama and French added to this model two new factors. They noticed that there was a tendency for small cap stocks to outperform large cap stocks, so they added a factor for firm size. And they also noticed that value stocks tended to outperform growth stocks, and so they also had a factor for this, which is essentially looking at book to market. Now, the Fama-French three-factor model was introduced in 1992, so this is well after Dimensional Fund Advisors was started in 1981, but the idea for DFA was to bring in some of the learnings from the economic literature and economic research and bring that into index funds. So both David Booth and Rex Sinkfield worked in index funds. Booth worked at Wells Fargo on some early stuff, and Sinkfield worked at American National Bank on early S&P 500 index funds. And again, going back to the literature, there was this notion that small cap stocks tended to outperform large caps, and so it's no surprise that their first product was a US micro cap portfolio. Over time, they added value, which of course makes sense given what we just talked about with Fama-French, and then international, fixed income, and others. The company is now headquartered in Austin, Texas, and as of late last year, 2026, had about $1 trillion in assets. Now, longtime viewers will know that my personal strategy is 100% passive, market cap weighted index funds, and generally I'm getting those from Vanguard. So my portfolio is constructed primarily of just two index funds. That's VTI, which is the total US stock market, and VXUS, which is the total international or ex-US stock market index. The mutual fund versions of these are VTSAX and VTIAX. Now, it is possible to much more simply just buy VT, that's the ETF version, that is the total global stock market index. I've got a video about that here that you can check out. The reason that I buy them separately is just to have a little bit more control over the US versus international balance, doing some rebalancing. And then also because there are tax advantages that could be had by holding the international components separately, outside of VT, especially, of course, in non-tax advantage accounts, aka brokerage accounts. That's because you can get a credit on foreign taxes paid. Anyway, so that's my portfolio, but let's kind of put a pin in that and dig a little bit deeper into what DFA funds are doing and how they have performed. So again, their kind of special sauce here is that they are going to be factor tilting more towards small cap and more towards value. They also, unlike completely passive indexes, don't operate on reconstitution schedules, so they don't suffer from the problem where everybody knows you're going to have to be buying and selling this in order to better reflect the underlying index on a certain date. Instead, they're able to kind of trade on a daily basis as they want to. Also, dimensional funds do some filtering. So they filter out small cap segments that they believe are going to be having lower expected returns. This includes small cap growth stocks with weak profitability or higher very aggressive investment, or those with high security lending fees as well. They also tend to exclude REITs or real estate investment trusts for tax purposes. And on that line, they do have a stated purpose of trying to be very tax efficient. both in terms of having lower churn, lower turnover, but I should say more specifically, but also in terms of trying to maximize long-term capital gains over having too many short-term capital gains. And then also another note on timing, they also do delay the purchasing of IPOs, which is another reason they've been talked about a lot lately, because of course the SpaceX IPO was kind of a big deal, and then those that have to kind of do it on a schedule, you know that they're going to have to buy up that stock at that time, and so that of course can cause some inefficiencies. In addition, there is some room, and they do state that they do try to do some loss harvesting when possible. All right, so has all this worked? Is this special sauce creating special returns? Well, I think it's going to depend on the time frame and also on the asset class. So this is a little bit old data. This is from as of 2013, but the white coat investor looked at different asset classes, different funds basically, and looked to see how they compared to the non-DFA counterpart. And we see that DFA performance is actually quite similar for many of these indexes over the 2003 to 2013 timeframe. That's a period of 10 years. We do see significant outperformance. In other words, DFA is doing better for US microcaps, US small cap value stocks, and international small caps. So this makes sense. This is kind of their idea basically, is that those small caps are going to outperform. But it's interesting that they're better than the index of basically those small caps as well. However, there are some cases of underperformance. Some are more marginal, so I won't talk about them. The only really significant one was in corporate bonds, where they underperformed by like 2.66%. The outperformance ones I mentioned, those were over 1% outperformance, but less than 2 percentage points. However, if you notice the column second to the right, you'll see what the performance is after a 1% management fee. And this is a big reason why maybe these weren't getting so much talk some years ago, but they're getting increasing talk now, is that it used to be the case that in order to get access to one of these funds, you had to be placed with an advisor, and that advisor would be charging a 1% management fee. I should mention that my understanding is if you use Ben Felix's services, that there would be a over 1% AUM management fee. However, of course, he is talking about these funds that are now available more widely. So starting in late 2020, Dimensional Fund Advisors launched ETFs that are available to the public at large, and has been adding more and more over time. So obviously, I would never want to pay a 1% management fee, certainly not to get access to these funds that show a very slight, if any, outperformance over the underlying index. But now that that 1% fee is not necessary to be paid, then these are kind of a little bit more interesting. And it behooves us at least to look at how they've performed against their Vanguard counterparts. So I've done that. I used a really nice tool called Portfolio Visualizer. Now, unfortunately, these dimensional funds haven't been around for very long. Again, we're looking at basically the summer of 2021 for the data for one of them, and then October of 2021 for the other. And the first one that we're going to look at, of course, is going to be DFUS, which is the counterpart to VTI. This is the total US stock market, essentially. So since July of 2021, the Dimensional Fund has outperformed the Vanguard Fund. Returns are 12.7% versus 11.9% for Vanguard. And this is achieved with some lower measures of risk, as standard deviation is lower, and also the max drawdown is lower as well. Part of this can be explained by the fact that REITs were excluded, but not all of the outperformance can be explained by the fact that Dimensional Funds excludes REITs from the total US stock market index. How about the international stocks? Well, the story is a little bit similar here. The dimensional version of VXUS is DFAX, and since October of 2021, DFAX has outperformed by gaining 10.63% compared to 9.57% with the Vanguard Fund. Now, we should note that expense ratios are a little bit higher for the dimensional funds than for the Vanguard funds. So DFUS has a 0.09% expense ratio compared to VTI's very low 0.03%. Both are very low though, mind you. DFAX has a 0.28% expense ratio, and that is quite a bit higher than Vanguard's expense ratio of 0.05%. Okay, so these funds have a slightly higher expense ratio, but even accounting for that, they have outperformed against the Vanguard counterparts over the last 5 years. So does that mean that I'm going to be immediately switching my entire portfolio over to dimensional funds? Absolutely not. Now, before I go into why, I do want to state that that doesn't mean that I think these are totally terrible and a horrible idea. As you can see, they actually are super strongly correlated, and they're really, really similar. So I don't think it'd be a terrible decision to go with either. However, when we go back to my investment philosophy, the basic idea is that I believe that over the long run, the market should do a better job than any particular individual at allocating capital. And for that reason, anytime that there are all these different places where an individual can either try to put their finger out and try to see which way the wind's blowing, or just, add a little bit of tinkering this, a little bit of tinkering that, that I do think that in the long run can lead to lower returns. So this just kind of goes against my investment philosophy. That's not to say though that it doesn't make sense. Some of the things they're talking about, like about, having to buy the IPOs at a certain date, or, reconstituting the fund on a certain date. Those are known sort of frictions that do exist. But then it turns into, okay, well, what about the timing, right? So you can have this problem, but if the solution to that problem is also going to involve a little bit of a view, then that can get you in trouble. And so for this reason, I am going to stick still with 100% passive market cap weighted index funds for my own portfolio. They may have underperformed over the last 5 years, but of course, past returns, of course, do not guarantee anything about future performance. So we'll see what happens in the years to come. But either way, I feel very comfortable sticking with my current portfolio. What are your thoughts? Do any of you have investments with Dimensional or some of their competitors? Let us know in the comments below. Please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.